Welcome back to Market on Close. I'm Tom White. It's time to discuss Mag 7 stocks and the need for diversification. For that, we're going to welcome in Mark Matson, CEO and founder of Matson Money, to the show. Welcome to the show, Mark.
Great to be with you, Tom.
Hey, so I just wanted to get your take here on the overall markets because we've had a nice 3-day run. There's still a lot of volatility out there. This is a headline-driven market at this point. But, hey, a little bit of a reprieve never hurt anybody, and it's been a good environment the last couple of sessions.
I think it's given investors, at least the last week or so, a little bit of opportunity to take a deep breath and calm down. One of the most dangerous things for investors is panic. And I'm always telling investors there is no right time to panic by definition. And when you have these massive drops that we've seen, especially since the last part of last year into this year, people start to do the wrong thing. They sell when prices are low. They buy when prices are high. And they move away from diversification and try to time the market, and very few people have the ability to consistently do that.
I think you bring up a good point because I've seen that over my trading career the last 30 years, from my time down the trading floor to now being on the retail side and now with the network, it's the bubbles that are out there, Mark. They come quick. They come too fast. People move their assets too quickly. They don't diversify enough. Do you expect that to continue, or is this little washout that we've seen in the market kind of reset everybody's thinking where, hey, you know what? We're not going to have 2 years straight of 20% gains anytime soon at this point, so you better start diversifying now.
And Tom, that is a really great insight. Look, for people that don't learn from history, they tend to repeat it. From 95 to 2000, the S&P averaged 22% a year per year for 5 years. Tech stocks averaged 45% per year for 5 years in a row. And of course, that's when most people dumped their money into those things at the top. And then what happened was in 2000, the S&P lost within the next 18 months 50%. Tech stocks lost 75%. And when you're looking at the Mag 7, now look, I manage over $10 billion for thousands of families all over the United States. And I can tell you when they come in and get their portfolios analyzed, what they own is the Mag 7 and the S&P. Tesla, not including today, and these stocks are up a couple, 2-3% so far today, but Tesla from its highs, 42% down. Right. NVIDIA, 30% down. And you got the year to date there. But this was at the end of last year. Apple, 20%. Microsoft, 19%. Alphabet, 24%. And Meta, Facebook, down 29%. Right. And most investors were not prepared for that type of risk or volatility. But the 5 years prior lulled them to sleep and made them feel completely bulletproof. The S&P made 100% over the last 5 years. Tech stocks, 123%. And international stocks clocked in lower at 25%. So everybody over-dumped into to the Mag 7, over-dumped their money into the S&P. They didn't use international diversification. Many of them didn't use any fixed income to offset volatility. And so they're really feeling the pain. Now, look, if you're 30, you might have time to overcome this. But you can't afford to lose 40-50% of your money when you're in your 60s or 70s using that money for your golden years in your retirement. So it's a whole different ballgame, and it depends on your time horizon, your risk tolerance, and there are no easy hints or tips in investing. It's a thing that takes a lot of analysis, a lot of time, and a lot of fortitude to be a long-term seasoned investor.
Yeah, you make good points, because this reminds me of like back in 2000, I'd get a cab, to go to work downtown in Chicago, and I'd have the cab driver asking me about if you should buy Yahoo when it was trading $700 a share. And I got the same thing with my family when I go back to holidays. They're like, "Hey Tom, should I buy Nvidia here when it's trading 150 and it's been up 200% in a year?" I get that point, but like when you talk to your clients at this point, because some of them want to do what they want to do, but at the same time, you got to kind of guide them a specific way where, hey, it's not going to be all 20% gains in equities and really higher risk assets, right?
That's right. I think this, next to trying to build diversification, understanding the risk in your portfolio is one of the most difficult things to do. And to do that, you need to look at your mix of assets, and then you need to look historically what would happen in down markets. And many investors are absolutely shocked to see that in 73 and 74, they would have lost 40% of all their money. In 2008 and 9, they would have lost 50% of their money. In 2000, many of them will remember 2020 because they lost 30% in the first 3 months, but then we had a massive recovery after that. But look, over the last 40 years, you've had 4 major crashes, including 9/11, including the financial crisis, including the tech crisis. And an investor should always know in advance, before they build their portfolio, how much they could stand to lose in a bad market. And most have absolutely no clue. And the other thing they think that will save them is some kind of prediction about the future. It is extremely hard to predict the future and beat the market because all the knowable and predictable information is already in the price. And shows like yours, you have these experts come on and they're studying it all 24/7. For an investor to think that they're going to get a leg up on the experts and beat the market in general is a fool's errand.
Yeah, Mark, when you start looking and the discussions that you have with clients moving forward, I mean, as far as diversification, I know it's all based on age, risk tolerance, all those good things at this point. But are there any opportunities that you're reflecting to your clients that say, hey, this might be a better spot for you at this time? Because I don't expect volatility to wane anytime soon.
Yeah, so I always expect volatility. Most people say they don't like volatility. It's only half true. They don't like the downside volatility. They love the upside volatility. Yeah. But there are some good academic research to tell a person how to diversify. So large company stocks, historically 10% rate of return. Money doubles every 7 years. Small company stocks have historically averaged 12%, but very few investors actually own them. In small value stock, but almost no investors own those because those look like distressed companies. Bad earnings, bad financials, their price earnings ratio show that they're distressed. But historically, they average way more than the largest companies. And then they need to diversify internationally. Look, you need to have, so far this year, while the S&P's down 9, large international value stocks are up 13. So that's a 21% difference in just a very short period of time. And you need to be in Europe, you need to be in Asia, you need to be in emerging markets. And then to the extent you can't take a whole equity risk, because there will be risk and you won't be able to time it, folks. You need to have high quality short-term fixed income so that when the market does crash, you can sell the fixed income, rebalance into the equity portion, bringing your portfolio back to balance. And that ensures that you're consistently selling the thing that's relatively up, buying the thing that's relatively down. But it's like, Tom, it's like a diet. Everybody knows how to do it. You eat less, you move more. Easy to say, hard to do.
Yeah, and we've seen a lot of flows into those short-term treasury type of products at this point. Hey, you can get 4% yield, and you don't see that drawdown at all either. We wonder when that money starts to come back in. Have we reached a bottom? Have we bounced enough? I think that's still questionable at this point, but great discussion, Mark. Appreciate it.
Great to be with you, Tom. Thanks so much, buddy.